Money FM 89.3. Best of breakfast. Eco Money on Money FM 89.3.
Emaad Akhtar here with Eco Money. With the growing focus on tackling carbon-related issues growing in light of climate change, mechanisms like carbon taxes and emissions trading systems, or ETS for short, have come to the fore in recent years. With an ETS, the policy involves setting a total cap or limit on carbon emissions, which makes companies switch to low-emission or renewable energy sources. In contrast, a carbon tax establishes a price directly on carbon emissions so that companies are charged a certain amount for every tonne of emissions produced. But more and more it's being argued that setting a tax does not reduce carbon emissions, since the cost can be partially transferred to end users or consumers. For more insights on this debate, we're joined by Daniel Lee. He's an associate professor of practice at the Nanyang Business School and also director of the Carbon Markets Academy at NTU's College of Business. Good morning, Daniel.
Good morning.
Daniel, research so far seems to indicate mixed results in terms of carbon taxes versus emissions trading systems, or ETSs. From your perspective, which of these two mechanisms has shown more promise and why?
My own view is that the specific context actually matters more, because both policy instruments really can be amended to what we say mimic elements of each other. So, for example, ETS with a price cap or floor can start to mimic elements of a tax, or in theory, if you have a tax which you amended based on how well the country was meeting its climate goals, then it starts to mimic elements of an ETS.
All right. Now, there seems to be a variance in the effectiveness of carbon taxes and emission trading systems depending on country-level characteristics such as financial development, GDP growth. What specific conditions should policymakers consider when choosing between these two carbon pricing strategies?
The main factors that policymakers should consider are A, institutional capacity, and B, political will. The first one is because, in general, institutional support capacity required to administer ETS is quite large compared to a tax. So, for example, regulators' perspective, how do you protect against market manipulation? How do you deal with price volatility? Who can trade? Who can participate? Is speculation acceptable? And then from a participant's perspective, you have to build organizational capacity to deal with the trading. Procurement function, is there a trading desk set up? What are the risks? How do I mark this in my book? So institutional capacity is important. And then political will was, tax is a loaded word, right? So in some countries, it's pretty hard to pass a tax. So it might be easier to get an ETS across the line.
Yeah, that's a good point, right? Carbon taxes can face strong political opposition from industries that especially rely on fossil fuels and from those who are concerned about the economic impact. So that perhaps weakens the argument for a carbon tax. Speaking of carbon taxes, they're often praised for predictability and simplicity on the other hand, while ETSs provide flexibility with market-driven pricing. How do you think these differences impact the practical implementation of these policies in different economies, particularly here focusing on emerging markets or developing countries?
Within the context of emerging markets or developing economies, I think some of the considerations typically would be, as I mentioned earlier, institutional capacity, right? And typically what we see is that if you are in an emerging market economy or just trying it out, there could be a tendency to try and phase it over time. So China went with pilot schemes for several years before creating a national scheme. Japan is doing a voluntary market first before transitioning to a compliance one. So that's one. Price levels is another. Should we set it lower first before raising it? So Singapore started with $5 and then now we are 25, 24. And then from what we see also in developing countries is that there's a tendency to try to implement crediting mechanisms along with that. So the ability to create domestic offsets in parallel with your tax and or ETS.
Do you think there are unintended consequences of carbon taxes? For example, increased carbon leakage where emissions shift to countries with less stringent regulations, or even job losses in carbon-intensive industries. Are these concerns in emerging markets?
It is entirely possible. So that's why in implementation of ETSs or carbon taxes, there is some consideration towards subsidies or assistance for what we call EITE sectors, or emissions intensive but trade exposed sectors as well. So we see that quite common feature.
So in your opinion, then, in a nutshell, how should carbon pricing evolve over time as countries move closer to their carbon neutrality goals? And how do you determine the optimal tax rate?
First of all, I don't think we are anywhere near our net zero goals, as it were. But in theory, if you get closer and closer, then it should matter less, right? Because the economy, essentially decarbonizes. So the question is, how are you getting to net zero? Is it because your overall emissions have reduced, or because you have a rising level of removal activity happening, in parallel? So if it is the latter, then you have to think about how your mechanisms evolve to continue incentivizing these removal activities.
Yeah, are there any perhaps case studies around the world that you can share that consider an effective approach for setting a carbon tax rate that balances the need to reduce emissions while minimizing economic disruptions?
I think in general, to minimize economic disruptions, you have to have some sort of guidance into the future. So to give some sort of predictability over time. So, for example, Singapore does a great job at sort of setting out a schedule for increases over time, right? Sort of from 25 to 45, and then eventually by 2030 between 50 to 80. So that's a good approach. It gives businesses time to plan, essentially.
Do you think that a case can be made for carbon taxes and emission trading systems to be implemented in tandem, or is it more effective for countries to focus on one mechanism over the other depending on their specific circumstances?
I think if you're starting from scratch, then the most logical approach would be to introduce it slowly and gradually before trying to do too much at one go, because you should not underestimate the amount of organizational knowledge and capacity that we need to build before people can fully deal with such a mechanism.
And there's often concern about the economic impact of carbon taxes, especially on vulnerable populations. What policies would you recommend to ensure that a carbon tax does not disproportionately affect low-income households or disadvantaged communities? There is an argument to be made that such taxes are regressive in nature.
Indeed. So the impact typically is either directly, for example, on increases in electricity or fuel costs, and then indirectly, from embedded price increases in goods and services. So, the classic redistribution sort of modalities work. So, direct assistance, like in Singapore, we have rebates, or other means-tested cash transfers like CDC vouchers. I mean, these are, proven ways of transferring back tax revenues back to certain segments of society that need it.
Yeah, I mean, as you rightly pointed out, electricity prices for households, I believe, increased last year here in Singapore as power generation companies faced a higher tax for their carbon emissions. So I think we're going to hit about between $50 to $80 of tax per ton of emissions by 2030, 45 per ton of emissions in 2026. Do you think that this is a good system that's been put in place?
I think it's necessary to get Singapore to transition to sort of net zero future. And so the question really is, how do we do that in the least disruptive way possible? And I think, at least in Singapore, we've had a deliberate approach toward making sure, we schedule the price increases so it gives certainty out there. But also the government's been quite clear that, it's revenue neutral. So it's not trying to raise revenue. And there will be assistance transfers back to the population.
Do you think there's any benefit in perhaps partnering with neighboring countries to try and, mitigate any potential pitfalls of carbon taxes or ETSs? For example, I believe a retailer here is developing a project in Indonesia to import electricity from solar power. Do you think such strategies could be beneficial in the long run?
Oh, definitely. Part of the challenge in Singapore is that from a renewable energy potential perspective, we are limited by space. You need a lot of space for solar panels, and we don't have a lot of wind as well. So, this kind of collaboration with neighboring countries is absolutely critical, because otherwise you're just increasing the price, but if you can't switch technologies, then, you're sort of pushing against a wall, as it were.
All right. Well, this is an ever-evolving discussion between the benefits of carbon taxes versus emissions trading systems. And we've been having this conversation with Daniel Lee, an associate professor of practice at the Nanyang Business School and also director of the Carbon Markets Academy at NTU's College of Business. Daniel, it's been a pleasure to have you on the show. Thanks for your time.
Thank you. Thank you so much.
Take care. Have a good weekend. Stay with Money FM 89.3.
To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.